Good morning, friends. This is Suresh, your commerce teacher from Government Degree College, Kukatpalli. Today, we will try to understand various forms of business organizations in India. Vaguely, we all know that there are sole proprietorship concerns, partnership forms, company forms of business, and so on. So, let us now deeply explore what each format of business means for us as far as organizational benefits and costs, advantages and disadvantages are concerned. At this juncture, I need not to define what is business. Simply, we all know that business is the conglomeration of economic activities carried forward with an intention of making profits. So, if you seek any entity for that purpose, it is called business organization, right? I already told you that business organization is any entity that conglomerates transactions into economic activities and attempts to derive benefits therein. So we need transactions. They may be production, manufacturing, distributing, supplying, selling, reselling. There are so many transactions we come across, and they are economic activities. Economic activity means any activity carried forward for some commercial consideration, some benefit. So, if you club these three, you can see the environs of business organizations, right? So, generally, there are five types of business organizations which we come across in Indian business environs. Let us see what are those five business important formats of organizations. So, here are five different formats, namely sole proprietorship, Hindu undivided family, partnership firm, cooperatives, and joint stock companies. Right? Whoever does business will have to function in either of these five formats, which we are going to discuss now. Let us start with sole proprietorship. Well, friends, it is the most commonest form of businesses in India. We see grocery shop just adjacent our house run by single man. It's a sole proprietorship. We see a bakery, a small bakery being run by a woman or someone else. It is a sole proprietorship. So it doesn't require any registration, right? All that you need is a PAN number, a TAN number, and a local license from Shops and Establishments Department to start sole proprietorship business. Of course, you need to comply with the tax norms such as filing GST returns if turnover exceeds 20 lakhs, filing income tax returns as you are a sole proprietor and you are the custodian of all the profits that a business organization is making. Therefore, the sole proprietorship is as good as a normal person carrying business. That is the reason why we call him proprietor, the owner of business. It has got so many advantages and equally disadvantages. Advantages is that the proprietor himself, that means the person who conceives the idea of business himself, will be the custodian of business. Therefore he can look after everything, right from quality, maintaining customer relations, so on and so forth. But at the same time he will have disadvantages, such as he will not have possibility of raising capital from public. He cannot aggressively expand the business as would be done in the case of joint stock companies or other formats of business. All that he will have is only bootstrapping. Bootstrapping is nothing but investing hard earned money or own money, the savings of family into business. That is called bootstrapping. Maximum he may get some extent of loans from banker as a retail proprietor. But beyond that, he cannot obtain large scale capital to expand his business. That is one disadvantage one sole proprietor will have to face and meet. Of course, despite all these odds, sole proprietorship is a very famous business format in India and holds sway for any generation. I can tell that with candidness because there are innumerable grocery shops, we see innumerable business activities that are being carried forward without any formal registration of a firm, company, or a society. Therefore, they have been playing a very dominant role in Indian economy, and most of them are in unorganized sector. Of course, they have to be brought into the ambit of organized sector. That is different thing. We will discuss about organized and unorganized sectors when we go for the next topics in economics, not here. So now the next important, the second most traditional and important format of business in India is Hindu undivided family. Well, friends, it is confined only to India. Some time ago, even Nepal had this format of business organization, but now it is only confined to India. It is governed by Hindu Succession Act 1956 and it is classified into schools, namely Dayabhaga and Mitakshara, depending on the governance of the Hindu undivided family business. Generally, the male head, that is the eldest male person in the family, shall be called as Karta of the family business. So he will be responsible for doing business, and all other members of the family are called co-partners. Right? I repeat, in Hindu undivided family, the eldest male counterpart is called Karta, who will be the head of business, and all the members will be called as co-partners. So why this concept of Hindu undivided family had to be recognized as a unique business format in India is traditionally there are certain families which are engaged in business as a dynasty tradition. Like we have Shroff's community, we have Chettiars, we have Kayas. So these communities are conventionally engaged into business as a dynasty activity. So to grant recognition to their business, government of India thought in the very beginning of independence itself that Hindu undivided family business must be recognized as a separate business format. And even today, it continues to exist. Of course, gradually, this HUF or Hindu undivided family concept is sliding into oblivion and they are getting converted into firms or companies owing to the traditional difficulties which are very formidable to overshoot. Generally, the first and second generations of family businesses will succeed to operate without any disputes. But when it enters into third generation, so the co-partners will increase naturally. They can't sustain the business format in family. So they will convert into firms or companies. That's different thing again, right? The third important business format or business organization which we come across in India is partnership firm. Well, partnership firms are governed by a separate law called Partnership Act 1932. So minimum of two members can form a partnership firm and the maximum of partners that a firm can have is 20. Of course, this maximum number of partners will be confined to only 10 if the partnership firm is engaged in banking business. Right? I repeat, in normal circumstances, in normal business activities, minimum of two members and maximum of 20 members can form a partnership firm. And if it is a banking business, minimum 2 and maximum 10 members or 10 partners can form a partnership firm. It is classified into unlimited liability firms and limited liability firms. Traditionally, partnership firms are of unlimited liability. That means partners in the firm will share their profits as well as in losses as per their profit sharing ratio without any limit. Whatever profit come, they have to share. Whatever loss come, they have to bear. That is conventional partnership form. But very recently, government has introduced a new format in partnership form, that is LLP, that is a limited liability partnership firm. It's a combination of partnership firm as well as a company. In company, shareholders will take limited liability. In the same fashion, in LLP also, partners will take up limited liability within the ambit of their profit sharing ratio, right? So partnership firms will be generally preferred when business is temporary. Suppose one construction project, one irrigation project, one roadworks project. So once the work is completed, they will cease the firm, they will cease the existence of business itself. So such format of business will prefer partnership firms. So generally in long run, very long run, partnership firms are not advised, rather it's not preferable, I will say they are not advised or advisable, right? So third important one, fourth important one we have is cooperative societies or cooperatives. Clear with the partnership form so far, right? So now let us make a move towards cooperative societies. Minimum of 10 members can form a cooperative society. There should be minimum one common element binding the members. Say, for example, agriculture cooperative society, all the farmers should be there. Milk cooperative society, milk vendors should form one society. Housing cooperative society, that means the members will have interest of housing or buying or selling or owning houses. So one common element should buy them. It is regulated by the state governments. Of course, very recently, as far as banking is concerned, government has issued an order that cooperative banks will be subjected to the prudential regulation of Reserve Bank of India. So apart from banking and finance, all other formats of business in cooperative societies will be subjected to state government regulations. Though the registration process, the governing and administration is subjected to common law called, that is Cooperative Societies Act 1911. See, cooperative societies are formed with one motive, that is one for all and all for one. So, all the members will contribute for the capital of the society, and that capital will be used for the common purpose in society. Generally, they are non profit making societies. Clear? So, the India's biggest cooperative society was Amul, Anand Milk Union Limited. So, Milk Federation. Very recently, some fertilizer cooperative has dominated Amul in terms of membership, right? So but Amul holds the credit of corporatizing cooperative societies also. A very sterling brand it has created for itself, right? So this is about cooperative societies, one for all and all for one, with a common element binding all the members. Remember please that minimum number of members can be 10, but there is no ceiling. That means any number of members can be there in society. There is no maximum limit as we see in the case of partnership firm, right? So the next important one, of course, very, very lengthy one is joint stock company. Someone said company is an association of many persons who contribute money or money's worth to the common stock employed in common purpose. That is company's way of understanding. But here you can see that there is a contribution of money, that is capital, common stock called shares of the company, employed in common purpose, that is objectives of the company. Of course, capital, objectives, shares, it's very lengthy topic that we will see in our law class. So this definition is informal, please. As far as formal definition of company is concerned, it is only a company registered under the provisions of Companies Act 2013 or its previous acts, right? So there is a checkered history of Companies Acts in India right from 1870s. But a major watershed was created with Companies Act 1956, which was there in existence till 2013. But recently, government of India has changed has replaced Companies Act 1956 with Companies Act 2013. So within these 7 years, now we are discussing this topic in 2020. So within 7 years, ever since New Companies Act has come into existence, it is amended many times. Companies Amendment Act 16, Companies Amendment Act 18, so on and so forth. There are many types of companies which we are going to learn now, but broadly ramified on the basis of formation, on the basis of membership, on the basis of liability, on the basis of control, on the basis of ownership, and of course on the basis of territory. Apart from this, I have also got another classification, that is on the basis of New Companies Act 2013. So we have seven different heads to classify companies, six which you are seeing on the chart, and the seventh one is the New Companies Act 2013, that also creates new companies which were not in existence before 2013. Now, let us see the classification of companies on the basis of formation, right? On the basis of formation, we have three companies, that is statutory company, registered company, and unregistered company. What is the statutory company? Well, any company which is brought into existence through special act of the parliament is called statutory company. For example, SBI has come into existence through SBI Act 1955. RBI has come into existence through RBI Act 1934, so on and so forth. So any company that comes into existence through parliament is called, a special act of the parliament is called statutory company. Why this name has come? A separate statute will be formed to enact such companies. Best example is SBI, RBI, right? So registered company. So simple. It's the commonest form of companies we come across in India. Any company that is registered under the provisions of Companies Act 2013 or the earlier Companies Acts which were there in existence till 13 are called registered companies, right? Simply a company formed under Companies Act. Next is unregistered companies. They are the organizations which are not registered as a company, but due to some special circumstances, they will be considered as company for all legal jurisprudences. That is called unregistered company. For example, we know that unless you are a company registered, you cannot collect public deposits beyond 25 crores. That provision is there. Suppose one chit fund firm is there, it has collected 50 crore rupees money or 100 crore rupees of money. So, in order to protect investors or depositors' money, what government does is we are considering this chit fund entity as a unregistered company. We will give you some time and go and register as a company. So for time being, you will also be considered as a company, but as unregistered company. Clear? So any organization which is not registered as a company, but due to special circumstances, it shall be considered as company. It is called unregistered company. Please mind it that unregistered company status will be very temporary. It will be occasioned either to convert into company format or to wind up the business as far as the judicial pronouncements are concerned. So on the basis of formation, we have three categories: statutory company brought into existence through separate act of the parliament, registered company registered through Companies Act 2013 or previous Companies Act, and finally unregistered companies which are not registered but deemed to be companies under special circumstances, right? Let us understand the second format of companies. Well, friends, on the basis of membership, we have three categories. Of course, I have given only two on the chart here. Third one I have taken into the next under Companies Act 2013. So now we have here only two, that is private limited company. Another one is public limited company. It is worth noting one person company also here, because we are bringing classification here on the basis of membership. What is private limited company? Any company that can be established with a minimum of 2 members and maximum of 200 members is called a private limited company. Minimum 2, maximum 200 members. And such companies required minimum capital of 1 lakh rupees. Minimum paid up capital of 1 lakh rupees. Such companies are not allowed to issue shares by prospectors. That means private limited companies cannot issue shares to common public like you and I, right? Second, public limited companies. Any company that can be formed with minimum of 7 members and no maximum limit is called a public limited company. Such companies requires minimum capital of rupees 5 lakhs, and they are only allowed to issue capital through prospectus. That means only public limited companies are allowed to issue capital to common public, right? So the name of private limited company should end with private limited. For example, Suresh Private Limited. If it is a public limited company, the name should end with the word simply limited. Now you tell, Wipro, Reliance, Infosys, are they private companies or public limited companies? Are they private? No, they are public limited companies, because these companies have issued shares to common public like us. You can also go to stock market. You can log into your Demat account and buy Infosys shares, Wipro shares, etc. Isn't it? That is the reason why you will see Wipro Limited but not Wipro Private Limited. Similarly, Infosys Technologies Limited but not Infosys Technologies Private Limited. So some people may argue public limited companies are government companies. No, they are public sector companies. There's a difference between public sector company and public limited company. A public limited company need not be government company. Simply a company which is formed with minimum 7 members and that is authorized to issue capital to common public, that can raise money from common public by issuing its share capital. There's a difference between private and public limited companies. I told you another classification is there, that is on the basis of membership. OPC, one person company, that we will see at the end, because it has got much to do with Companies Act 2013 as compared to that of Companies Act 1956, right? Now let us go to the next classification. Now, on the basis of liability, companies with unlimited liability, they are as bad as partnership firms. The shareholders will have to bear unlimited liability towards third persons. See, the very beauty of forming company is that members will limit their liability only to the extent of shares held by them. That too only to the extent of unpaid amount of shares purchased by them. If shares are fully paid up, then they need not to hold any liability towards third persons. For example, company's price is 100 rupees. I mean, share price is 100 rupees. I have paid 90 rupees to company. Only 10 rupees I have to pay. So it is paid up to the extent of 90 rupees and unpaid only to the extent of 10 rupees. So if any liability comes towards third person, I will hold liability only to the extent of 10 rupees per share that I purchased. So if shares are fully paid up, I need not to hold any liability. So these companies with unlimited liability are only betokened in theories. They are not seen anywhere. Second, companies with limited liability. They are very common. Liability will be limited either by guarantee or by shares. So limited by guarantee is also theoretical in nature. So in memorandum of association of company, there will be something called liability clause, in which sometimes in very rare occasions they will give guarantee that we, the shareholders of company, will guarantee the payments only to the extent of 20%. Some guarantee will be given. So they are very rare in nature. The most common 99.9% of the companies which we see are limited by shares, right? So here the liability of members or shareholders of a company are limited only to the extent of unpaid amount of shares held by them. If shares are fully paid up, their liability is absolved. Clear? So this is the commonest form of company which we see everywhere in India, right? So I'm often interchangingly using member and shareholder. There's a difference between shareholder and member. Even if you buy a single share in company, you will become a shareholder, but you will become member in company only when you purchase the qualification number of shares prescribed in the memorandum. Suppose one company may say in the capital clause of its memorandum, if anyone buying only 100 shares or minimum 100 shares will be a member. That means if less than 100 shares are purchased, you are a shareholder. If minimum 100 are purchased, you are a member. So that is the difference between shareholder and a member. Right now, of course, after completing the classification of companies on the basis of liability, now we will see the classification of companies on other basis. Well, the next one is on the basis of control. We have here holding companies and subsidiary companies. Holding company is one which controls the business of other company called subsidiary company. Confused? So when can you control the business of others? When you have majority stake. When can you have majority stake? More than 50. That means if you have minimum 51% of shares in other company, you are a holding company and that other company is called subsidiary companies. Clear? Any company owning minimum 51% of equity shares in other company is called holding company, and the company in which we have minimum 51% shares is called our subsidiary company. So clear it is, isn't it? So next we will see the classification of companies on the basis of control, sorry, on the basis of ownership. On the basis of ownership, we may have government company and non-government company. What is government company? A company in which central and or state governments owns minimum 51% equity shares. It is called a government company, isn't it? So these are called public sector companies or simply public sector undertakings, PSUs. Government, here government means it can be central government or state government or collectively central and state government together may hold minimum 51% of shares. It is called a government company. Second is non-government company. Obviously, in any company in which government does not hold minimum 51% shares is a non-government company. It can be 0% also, isn't it? That means all private limited, public limited, anything. It can be a non-government company if government doesn't own minimum 51% of shares in it. Clear? Right. Next classification is on the basis of territory, domestic company and foreign company. So simple. Any company having headquarters in India, the registered office in India is called a domestic company. No matter whether you have business in India or abroad or elsewhere, but your registered office must be in Indian frontiers. Within Indian frontiers, it is called a domestic company. On the other hand, any company the head office of which is outside India is called a foreign company, right? And have business in India. A company may have business branch in India or subsidiary in India, but its head office must be, the registered office must be outside India. It is called a foreign company, right? So simple, isn't it? Now, next, let us see the classification on the basis of New Companies Act. Well, our Companies Act 2013 has incarnated New company formats like associate company, number one. What is this associate company? Associate company is one in which one company will have minimum 20% of shares, right? It will be our associate company. Dormant company. Dormant company is one which is registered but not in a position to carry on the business. Generally, this type of companies are created to protect the intellectual properties like patents. So, unless I registered a company and get my patent done, so it will be not acceptable for production. So, dormant company is something or some company which is simply registered but doesn't execute business. Generally, the status of dormant company will be given once you are not in a position to carry the business or commence the business within 1 year from the date of incorporation. So the status of dormant company is very temporary. One day or the other, it has to convert itself into normal company. So you can't declare yourself as a dormant company. You must apply to government that yes, I got a concept with me, but I will not execute the business right now. Please register my company and declare me as a dormant company. Then government will give you dormant company status. When it will give, when you are not in a position to carry the business or commence the business within 1 year of establishing your company. Next, we have defunct company. What is this defunct company? Any company which fails to commence business or carry business for 2 financial years, or any company which fails to submit annual returns along with financial statements continuously for 2 financial years, it is called a defunct company, right? So 2 financial years you are subsequently not in a position to commence the business, or you are not in a position to submit the income tax returns or annual returns to government, then also you are a defunct company. Mind it please, once you obtain dormant company status, you will not be declared as a defunct company. If you don't obtain dormant company status and yet 2 financial years are completed, you are not doing business and you are not submitting returns to government, then you are a defunct company. It can be wound up by the government, please. Next, we have Section 8 companies. These companies are so-called Section 8 because they are defined in Section 8 of Companies Act, New Companies Act. So these companies are formed with a non-profit motive, such as promoting culture, promoting social welfare, promoting arts, sports, etc. Generally, companies will form this type of Section 8 companies as subsidiary units to execute their corporate social responsibilities. That we'll discuss in our next chapters, right? Simply remember that Section 8 companies are formed without any profit motive. One person companies, OPCs. Even a single person now can form a company, but the name of the company should be ended with OPC. If you have company name AB company, second line must be OPC, that is one person company. You should have your nominee. If you are forming a company not without any partners or members, you are a single person, you must give details of nominees. That means after you, who will carry the business, that nominee details must be given. So that is one person company, and one person company cannot be a bigger company, it must be a smaller company only. So the question comes, what is small company? A small company is one the turnover of which doesn't exceed 2 crore rupees, or the capital doesn't exceed 50 lakhs rupees. Either your capital should not exceed 50 lakhs or turnover should not exceed 2 crores. If either of these things happens, it is deemed to be a large company. So OPC must be a small company, right? So the new format, New Companies Act 2013 unleashed associate company, dormant company, defunct company, Section 8 company, and one person company, along with small companies. Clear? So, this is the classification of companies. Friends, so far we understood sole proprietorship, Hindu undivided families, partnership forms, cooperative societies, and joint stock companies. If you see this lesson, the lion's share of discussion is attributed to joint stock companies. We have seen classification on the basis of formation, on the basis of membership, on the basis of liability, on the basis of control, on the basis of ownership, on the basis of territory, and finally on the basis of New Companies Act 2013. These are seven different variants, and again in each variant we have many formats of business organizations in company sector, right? Therefore it implies that company form of business has got much to do in the future literature that we are going to discuss either, right? So with this we will have a break here, and we'll see in the next topic how to form a company, right? So, friends, I am giving you assignment at the end. If you remember well, in the very beginning, while discussing Hindu undivided family, intentionally I have not touched what is Mithakshara school and other school, that is uh, Hina Akshara School of Business. So, in Hindu undivided family, which you have to explore and tell me in the next class what these schools of Hindu undivided family are. And you also need to discuss me with me what are the legal provisions governing Section 8 Company of New Companies Act 2013. I repeat, your assignment questions are: what are the two different schools of Hindu undivided family? You need to go to Google, explore, and tell me in the next class. And similarly, what are the legal provisions governing Section 8 company? Right? That's all for now. See you in the next class. Bye.